You know that feeling, right? The world just feels uh, kind of wildly unpredictable lately.
Definitely.
Every day, it's just this fire hose of information, you know, geopolitical shifts, supply chain snarls, the whole landscape of work changing,
Yeah.
like right before our eyes.
Yeah, it's a lot to keep up with.
You're trying to stay on top of it, reading articles, scanning reports, and sometimes it feels less like navigating and, well, more like just getting completely swamped.
Mm.
Feels really complex, doesn't it? Like the rules of the game are just constantly shifting under your feet. But
Mm.
what if that feeling of being overwhelmed isn't just about complexity itself?
That's actually the perfect place to start, I think. The sheer volume and the pace of change are just undeniable.
Right.
And you hit on something really crucial there, that perception of overwhelming complexity.
Exactly. So for this deep dive, we've really gone deep into a pretty significant source. The 2025 Global Business Complexity Index. You might see it called the GBCI report.
It's a huge piece of work, really comprehensive.
It is. It surveys, 79 different jurisdictions, and they represent this enormous chunk of the global economy, something like 94% of global GDP and 95% of net foreign direct investment.
So yeah, not just a snapshot, it's a really wide-angle view of what businesses are facing, globally.
Right. And our mission here really is to help you make sense of it all. To take this massive report, which, by the way, was shared by one of our listeners, thanks for that, and pull out the absolute most important insights.
Yeah, the stuff you really need to know to be well informed about navigating this global business landscape right now. We want to help cut through that noise you mentioned.
And the report makes this really key distinction right at the beginning. It's one that kind of changes how you think about everything else it talks about. It draws a sharp line between complexity and uncertainty.
Uh-huh. And that distinction, it's fundamental, really is. The report defines complexity basically as the administrative burden that comes from known rules.
Okay, known rules,
Yeah.
like red tape.
Exactly like red tape. Think of it as, the established processes, the regulations you already know you have to follow. These things, they tend to change, but relatively slowly.
Right.
Which is why the report's complexity ranking changes year to year, but usually, only incrementally. It's the steady state stuff.
Okay, so complexity is the sort of static challenge, the hurdles you know are there, but uncertainty, that's the variable, the unpredictable storm.
That's it, precisely. Uncertainty, according to this report, comes from the sudden, really dramatic shifts, unexpected government policy changes, maybe, or sudden trade disputes like, bam, new tariffs out of nowhere, major geopolitical events.
Like the pandemic.
The pandemic was a massive source of uncertainty, absolutely. These things are just hard to anticipate, really hard to plan for. And the report argues quite strongly, actually, that uncertainty, much more than the inherent complexity of the rules, is the biggest challenge for businesses today, especially the multinational ones.
Wow, okay. That immediately reframes things, doesn't it?
It does.
Because you can build systems, processes to handle complexity over time.
Mm-hmm.
But uncertainty, that needs constant sort of reactive adaptation.
Mm-hmm. Flexibility.
And the report links complexity itself to economic outcomes too, right? It's not just some academic idea.
It does, yeah. There's a really interesting finding that higher administrative complexity often correlates statistically with lower GDP per capita.
Huh?
And they give this compelling example comparing Denmark, which always ranks really low in business complexity, very simple, with Brazil, which ranks quite high, very complex.
Okay, big difference there.
Huge difference in administrative burden. But here's the kicker. Both countries have relatively similar, quite high standards when it comes to crucial things like social protection, environmental standards.
So, hang on, all that extra complexity, all that red tape in a place like Brazil isn't necessarily buying you better social outcomes or environmental results compared to a much simpler place like Denmark.
That seems to be the implication.
It's just adding friction,
Yeah.
administrative cost. Arguably, kind of needless burden on businesses.
That's certainly the report's perspective. It's the cost of inefficiency baked into the system. And businesses, well, they're having to adapt their fundamental strategies to deal with all this.
How so?
The report touches on the whole evolution of globalization itself. We used to talk about globalization 1.0.
Right, the sort of China-manufactured, U.S.-sold model,
Yeah.
roughly.
Yeah, often characterized that way. Production concentrated in places like China, supplying markets primarily in the U.S., relatively straightforward, geographically focused supply chains.
Okay, simple enough.
Then we saw globalization 2.0. This was influenced by things like rising costs in China, maybe increasing trade tensions, and that led to the whole China plus one strategy.
Ah, yes, where companies started adding production or sourcing maybe in Vietnam or Mexico, somewhere else too.
Exactly. A bit of diversification, but still largely focused on, cost efficiency, spreading the manufacturing base a little. And now the report suggests we're moving into what they call globalization 3.0. And this phase, it's directly shaped by the big disruptions we've all lived through recently, the pandemic,
Yep.
obviously, geopolitical tensions heating up, those supply chain vulnerabilities that became painfully clear, like the Suez Canal blockage.
Yeah, you really saw the risks of having all your eggs in one basket.
Precisely. The lesson learned is the huge risk of concentrating critical operations or sourcing in just one or two places.
So 3.0 is driven more by the need for resilience, for risk mitigation, through more diversification.
That's the core idea, building more distributed supply chains, often more regionalized ones. The report highlights, the US and China are massive economies, right? Together, they're like 45% of global GDP.
Huge.
Yeah, but that still leaves 55% elsewhere. And that 55% is a diverse and growing market. So diversifying your trade partners, where you source from, where you manufacture, where you sell, it's becoming, well, essential, not just nice to have.
But wait, that sounds like it inherently adds complexity, doesn't it?
Yeah.
If you're operating in more countries, that means more sets of regulations, more legal entities, more different systems to manage.
It certainly adds external complexity, no doubt about that. But here's a really key insight from the report. Businesses can actually manage this increase in external complexity by actively reducing their internal complexity.
Internal complexity. How do they do that? What does that mean?
It means streamlining their own corporate structures, maybe having fewer legal entities overall, fewer overlapping internal processes, consolidating functions like HR or accounting, perhaps by using fewer external vendors across the board.
Ah, okay.
So by simplifying their internal operations, businesses can free up capacity, free up resources to better navigate that increased external complexity that comes with diversifying geographically. It's a strategic balancing act.
Okay, that makes perfect sense, actually. You're facing external uncertainty and the complexity that diversification brings, so you try to create internal efficiency and simplicity where you can control it. That really sets the stage for everything else, doesn't it?
It absolutely does. And the report really digs into three major global priorities that are driving these shifts and shaping the landscape for businesses right now.
Okay, let's unpack those then. The first one is all about building resilience, specifically through diversified pathways and trade corridors.
Yeah, and this is where those geopolitical shifts we mentioned have a really direct impact. The report found that globally, 22% of jurisdictions see challenges accessing trade corridors specifically because of geopolitical changes.
22% globally. But that number is way higher in some places, right? I think it said South America.
Dramatically higher,
Yeah,
jumps to 60% in South America, which just shows how localized and intense these challenges can be depending on where you operate.
definitely. So how are businesses responding? What are they doing about it?
Well, diversification is key. Over 55% globally are prioritizing diversifying their trade relationships, actively looking for alternative partners, alternative routes.
And in North America, that number's even higher.
Strikingly higher yet.
Yeah.
77% in North America are focused on diversifying trade relationships. It's clearly a top priority there.
And it's not just about diversifying who you trade with, but also about diversifying the economic activity within a country itself, right?
That's another important angle. The report points to India, for example. India is actively focusing on building up its manufacturing sector alongside its traditional strengths in agriculture and services, creating multiple pillars, for economic resilience.
Makes sense.
And they also mention Colombia's Orange Economy initiative. That's about promoting tech and creative industries, again, to reduce reliance on maybe more traditional sectors and build a more varied economic strength.
And this diversification strategy, it ties into the growing importance of regional trade hubs, too.
Absolutely. The report notes an increase in regional integration becoming more important. It was particularly significant in South America, where its importance jumped up to 70% this year.
So certain places are really positioning themselves as these crucial connection points.
They are. The report mentions Jamaica, for instance. It's leveraging its strategic location connecting the Panama Canal, the wider Caribbean, South America, and they cite the recent dredging of the Kingston port to handle larger vessels as a concrete example of infrastructure investment supporting that hub strategy.
Okay. Any others?
India is emerging as a hub for what they call global capability centers. Singapore, of course, remains a vital gateway for the APAC region, and they're investing heavily in port technology and infrastructure development.
And sometimes places benefit from trade routes shifting, maybe because of geopolitical tensions.
Yeah, that's happening too. For instance, trade flows shifting away from Russia have apparently benefited some neighboring countries. Kazakhstan is mentioned having a significant number of Russian language speakers, helps facilitate communication, and Poland, too, due to its geography and infrastructure. They're seeing increased interest from industries and trade routes looking for alternatives.
And presumably, governments are often investing in infrastructure, ports, roads, rail to support these new corridors.
They are, yeah. The report notes that 35% globally are making significant government investments in infrastructure with these goals in mind. It's even higher in North America, 46%, and APAC at 43%.
But it's not always smooth sailing with that infrastructure, is it?
No, the report also points out that this investment can be pretty uneven within countries. They give the example of Italy, excellent infrastructure in the industrial north, but less developed networks down in the south, which can create internal bottlenecks.
Right. And public-private partnerships are playing a role too.
Definitely. Greece's ports are mentioned as an example, attracting private investment to drive those needed infrastructure improvements.
But alongside all these efforts to build resilience through diversification and infrastructure, there's still that uncertainty factor, particularly around trade policy.
Huge factor. Changes in trade policy, the risk of retaliation from other countries, these add significant layers of uncertainty. The report mentions, for example, U.S. tariff plans and the lack of clarity on their long-term effects, how other nations might respond.
And that has real consequences.
Oh, yeah. There's a U.S. expert quoted in the report noting the potential for these kinds of tariffs to actually contribute to inflation back home. So it's not just an external issue.
That's a direct impact that can ripple right through supply chains, affecting costs for businesses, ultimately for consumers too.
Wow.
The report really emphasizes the value of having multiple strong regional relationships agreements.
Absolutely critical. Nearly 50% of jurisdictions cite having strong regional trade relationships and formal agreements as a key factor enabling them to choose alternative trade routes when disruptions hit. Those agreements provide the framework.
And what about the big one, U.S.-China trade?
The report approaches that cautiously. It just notes that U.S.-China trade is facing some barriers, acknowledging the effects of recent policies without perhaps overstating their nature. Still a massive trade relationship, obviously.
Okay, so if we boil this down, what's the core takeaway here for businesses trying to navigate this first global priority, these shifting resilience pathways and trade corridors?
Well, what's really fascinating is how these geopolitical shifts and the strategic responses, the push for diversification, the rise of regional hubs, the infrastructure investments, they're essentially redrawing the global trade map in real time. We're watching it happen.
Yeah.
And the key insight, I think, is that diversification. It's no longer just a strategic option for growth or efficiency. It's become a fundamental necessity for building resilience against this backdrop of unpredictable global uncertainty.
And for you, our listener, why does understanding these shifting trade corridors actually matter day to day?
Because it helps you anticipate where opportunities might be opening up, but also where new risks are emerging. If your business is involved in global sourcing, manufacturing, logistics, selling internationally, knowing which routes are becoming more viable, where new bottlenecks might appear, how policy is influencing trade flows, that's vital intelligence.
Right. It helps you find alternative suppliers maybe, or identify potential new markets, or just prepare for potential cost changes down the line.
Exactly. It's about seeing the future shape of global trade, or at least trying to anticipate it.
Okay, moving on then. The second major global priority the report highlights is managing supply chain risk. This feels, inherently linked to everything we just talked about with trade routes.
It absolutely is. They're two sides of the same coin, really. Geopolitical instability, disruptions to shipping, they directly translate into higher costs, interrupted routes, and shortages of critical supplies.
Yeah, we've all felt that.
Definitely. The report gives examples like New Zealand and Saudi Arabia economies that are heavily import dependent. They particularly feel the pinch when global trade routes get messed up. There's a quote from a Saudi expert highlighting how their reliance on global maritime trade makes them vulnerable, even as they're trying hard to build up local industrial capacity.
So what are businesses actually doing about this risk? What are the strategies?
The report identifies two major strategies businesses are leaning into. First, supplier diversification. Second, significant investment in technology.
Okay. Supplier diversification makes intuitive sense. Don't put all your eggs in one supplier basket for something critical.
Exactly that. The report emphasizes it reduces single points of failure, adds flexibility, and there's a quote from a Peru expert which adds another dimension, suggesting diversification can actually open doors for innovation and growth by bringing in different expertise from varied sources, not just risk reduction, but maybe opportunity too.
Interesting angle. And technology. How is tech playing a role in mitigating supply chain risk?
Technology investment is seen as crucial, really crucial. 24% of jurisdictions reported using technology right now to identify current supply chain risks. And 18% are investing in tech specifically to prepare for future disruptions.
What kind of tech are we talking about?
Things like broader digital transformation initiatives, advanced tracking systems, mapping technologies to really visualize and monitor supply chain routes in detail. Brazil, for instance, is cited for using technology to track transport and products in real time.
So having that granular real-time data is the key, knowing exactly where everything is.
Absolutely. There's a great quote from a Poland expert who stresses that everything in supply chain management starts with data. Precise data on production, transport movements, even external factors like weather forecasts. You need that data to optimize logistics, ensure efficiency. And looking ahead, technologies like AI and blockchain are seen as having increasing potential to improve visibility and predictability even further.
And businesses don't always build all this tech themselves, right? They partner up.
Often, yeah. They rely on specialized partners. Third-party logistics providers, you hear them, called 3PLs, and advanced management software platforms offer capabilities that many companies, especially maybe smaller ones, just might not have internally.
Makes sense.
The report uses Amazon as an example, actually, highlighting how their really advanced tracking and distribution technology can be leveraged by smaller clients. A U.S. expert, quote, points out how Amazon's tech reliance enables incredibly complex logistics, which others can tap into.
We're also seeing trends like reshoring or nearshoring, bringing production closer to home, or at least closer regionally.
Yes, that's another strategy the report definitely touches upon. Japan, for instance, has specific government initiatives supporting companies that move their supply chains back home, or maybe to closer ASEAN countries. This often aligns with broader government policy goals, sometimes maybe protectionist in nature.
Does that ever create a tension? The government pushing for local sourcing, but as businesses feeling they need global diversification for resilience.
Yes, the report points out that this tension definitely exists. Initiatives designed to boost local capacity. They mention Saudi Aramco's program prioritizing local content in its supply chain, as an example, while great for the local economy, can sometimes conflict with the company's primary goal, which might be global diversification to reduce geopolitical or logistical risk. It's a balancing act.
And how much support are governments actually offering to help businesses manage all this supply chain risk?
It seems to be a bit patchy, according to the report. While some jurisdictions do offer support, maybe through infrastructure projects, trade policy tweaks, financial incentives, or regulatory help, it's often perceived by businesses as weak or inconsistent.
So infrastructure is still king.
Strong national infrastructure is repeatedly highlighted as absolutely crucial for supply chain resilience. They illustrate this by comparing Saudi Arabia's robust infrastructure, which is really supporting its Vision 2030 goals, to Ecuador's uneven road network, which apparently creates logistics bottlenecks despite other efforts. An Ecuador expert, quote, details that quite well.
So while governments can play a role, the main burden for managing supply chain risks still falls largely on the businesses themselves.
That seems to be the overall picture painted by the report, yes.
Mm-hmm.
And connecting this back to the bigger picture, while adopting new technology and diversifying suppliers might add some initial complexity, managing more relationships, more systems, the core insight is that these are no longer optional extras. They are essential foundational tools for navigating the inherent and frankly increasing risks in global supply chains today.
Which leads to a really important question the report kind of implicitly raises, doesn't it? How do businesses effectively balance the strategic need for global risk reduction, spreading things out, with potential pressures for more localized sourcing or maybe internal operational consolidation to save costs?
It's one of the core strategic challenges in modern supply chain management, absolutely. Balancing that external resilience push with the internal efficiency drive.
Tricky stuff. And for you, our listener, if your work involves any part of a supply chain, maybe you're in procurement, logistics, manufacturing, or if your business just depends on importing or exporting goods, Understanding these factors is vital.
Hmm.
Geopolitical instability, the push for diversification, the role of technology, the sometimes patchy government support. These are the forces directly impacting your costs, the availability of your materials,
Yeah.
and the overall reliability of, getting your product to market or just getting what you need to operate.
They really shape the operational reality you face every single day.
Okay, let's shift to the third major global priority the report focuses on. This one feels particularly close to home for many of us listening. Labor market trends and the whole evolving world of remote working.
Yeah, this is a significant area of concern and focus in the report. Unsurprisingly, maybe, salary inflation is highlighted as a major global worry, reported by 70% of jurisdictions.
70%. Wow. What are the main drivers behind that? Is it just general inflation?
It's several factors at play, really. Broad economic inflation is definitely part of it, but also government-mandated increases in minimum wages in many places, and then just strong demand in specific sectors, creating wage pressure, bidding wars for talent.
Right.
There are expert quotes from different regions illustrating this. Europe is seeing rising costs of living, really pushing salary demands. Ecuador's minimum wages are apparently increasing faster than productivity gains. And Indonesia has really high demand driving up costs, particularly in manufacturing and tech sectors.
So how are companies reacting? Just paying more?
Primarily, yes. They're responding by offering more competitive pay and benefits packages. The report says this is a widespread strategy, particularly prevalent in EEA, that's Europe, Middle East, Africa, 98% there, and APAC, Asia Pacific, 93%.
Huge numbers.
Yeah. Many are also using performance-based bonuses, various allowances. There are examples cited from Belgium, India, Indonesia, showing companies really building more attractive compensation structures just to compete for talent in these tight markets.
Despite some of the current economic pressures, does the report offer any optimism for the near future on this front? Any light at the end of the tunnel?
Yes, interestingly, it does. 77% of jurisdictions actually see the possibility of improved economic stability over the next 5 years.
Oh, okay.
So it suggests that while salary inflation is a major current headache, the underlying economic volatility that's driving some of it might ease slightly looking ahead. Fingers crossed, maybe.
Maybe. But beyond just salaries, retaining staff seems like a massive challenge right now. The Great Resignation might have cooled, but turnover is still high.
It really is a major issue. Nearly half, 47% of jurisdictions reported an increase in staff turnover in the last year. Now, slightly more didn't see an increase, but where it is high, the report points to factors like those tight labor markets, economic instability, making it easier or more necessary for employees to move.
Any specific examples?
Yeah, the Saudi Arabia expert highlights how the rapidly growing economy is actually increasing competition for a limited talent pool, driving turnover.
And there's also the issue of skilled workers actually leaving certain countries. A brain drain.
Yes, the report mentions talent drain or skilled technicians leaving for better opportunities abroad. They cite examples in Ecuador and Indonesia.
That's tough for those economies.
It is. And there's also an interesting observation from a Belgium expert quoted in the report. They suggest that in a very tight market, employers sometimes end up holding on to underperforming staff simply out of fear of not being able to find replacements.
Oh, interesting point.
But that can inadvertently demotivate and actually contribute to higher turnover among the better employees who get frustrated. So it's a tricky dynamic.
And the report states that attracting and retaining talent is difficult for a huge shoes. 80% of jurisdictions this year. 80%.
That number really jumps out, doesn't it? It's clearly a global phenomenon. But the report notes the most significant increase in difficulty compared to last year was actually in North America, underscoring the growing severity of this challenge in that region specifically.
And alongside all this, employee expectations seem to be fundamentally shifting, particularly for younger generations like Gen Z.
Absolutely. The report really highlights this. Younger professionals, especially Gen Z, are just less willing to tolerate work environments that don't align with their values, particularly regarding flexibility and work-life balance.
Flexibility is key.
Massively key. There's a Brazil expert quoted saying that Gen Z employees are even refusing lucrative job offers if they require a strict 5 days a week in-office presence. Flexibility is increasingly becoming, well, non-negotiable for many.
So offering flexible work options isn't just a perk anymore, is it? It's becoming a core retention strategy.
Precisely. And a necessary one, frankly, given the high costs associated with turnover and the difficulty in finding skilled replacements. Which brings us directly to the widespread adoption of hybrid and remote work since the pandemic.
Right. It's pretty prevalent now.
Very prevalent, particularly in urban centers and in sectors like tech, finance, professional services. But the report clarifies it's mostly hybrid models that are most common.
Not fully remote everywhere.
No, full remote acceptance really varies by region and industry. And crucially, the report notes that employer preferences often don't align perfectly with employee desires. There's a Mexico expert quote mentioning employers often wanting, say, 3 days in the office, while employees would prefer more remote time. That negotiation is ongoing.
What about government support for this shift towards remote and hybrid work? Are they getting involved?
Many governments are, yes. They're actively supporting it, recognizing benefits like maybe reduced traffic congestion, potentially improved work-life balance for citizens. A significant 73% of jurisdictions are actively establishing legal frameworks for remote and hybrid work.
Oh, that many.
Yeah. They cite specific laws enacted in places like France and Italy, and official guidelines published in Singapore as examples. So regulation is catching up.
But some regions are lagging behind on that front.
Yes, APAC Asia Pacific is specifically noted as lagging in this legislative area. Only 36% of jurisdictions there have specific legal frameworks in place for remote work.
And what does that mean in practice?
Well, it can create uncertainty for both employers and employees. Uncertainty around issues like defining working hours, ensuring safety standards for home offices, figuring out tax implications when people work across borders. An India expert, quote, highlights this lack of comprehensive regulation for home-based work there, creating ambiguity.
The report also mentions some other maybe newer pay-related trends like earned wage access. What's that?
Yeah, that's the ability for employees to access a portion of their earned wages before the traditional monthly or bi-weekly payday, like getting paid daily or weekly for work already done.
Ah, okay.
Okay.
Is that becoming common?
It's becoming a more significant consideration. 72% of jurisdictions noted it as a factor. Technology obviously enables this flexibility, but the report also points out it can add complexity to payroll processing systems.
Sure, I can see that. And are mandatory regular pay increases making a comeback?
Yeah.
Like cost of living adjustments?
It seems so. After a period where they were maybe less common, 33% of jurisdictions globally now report mandatory regular increases are back on the agenda. And this trend is particularly strong in South America, 70% there, and North America at 50%.
Okay, so pulling all these labor market trends together, this is where it gets really interesting, isn't it?
Yeah.
When you connect the dots between the talent shortage, the rising costs, the shifting employee demands for flexibility, the evolving regulations around work.
Right. You see companies grappling with all these external forces, pushing labor costs up, making talent harder to find and keep. But here's the fascinating paradox the report identifies. It's really striking.
What is it?
While businesses are strategically diversifying their supply chains, spreading them out geographically for resilience, they are actively seeking uniformity in critical internal services like HR and payroll.
Uniformity, you mean like consolidating vendors?
Yeah.
Using fewer providers?
Exactly that. They want integrated solutions. They want fewer HR and payroll providers to manage internally, even if they operate in many different countries. There's a U.S. expert quote about the rise of global payroll providers who can handle multiple countries through one platform that highlights this trend perfectly.
Wow. So externally, it's fragmentation and diversification to manage risk. But internally, it's consolidation and simplification to manage operational efficiency and complexity, especially in those back office functions.
Precisely. External diversification meets internal simplification. It's a really powerful tension-shaping business strategy right now.
That is fascinating. So externally, businesses are spreading out to mitigate risk, but internally, they're pulling back in, seeking consistency, control, especially in areas like HR and payroll.
It is. And technology, again, plays a dual role here, too, doesn't it? It enables both the external diversification, think supply chain tracking tech, and the internal simplification, like those integrated global payroll systems.
Right.
The report mentions government efforts to simplify compliance through technology too, like Saudi Arabia's Quiwa portal for labor services or Finland's unified social security system. And it notes that global providers are leveraging technology to offer these more integrated services across borders.
And for you, our listener, what's the takeaway here?
Well, whether you're an employee navigating these new hybrid work expectations, or maybe you're a manager trying desperately to attract and retain talent in a really competitive market, or perhaps you're a business owner dealing with rising labor costs and increasingly complex regulations around work. These are the forces fundamentally shaping your daily work experience. And understanding this core tension The external push for diversity versus the internal drive for uniformity is really crucial for strategic planning right now.
Okay, let's move into the core business functions the report examines in detail, starting with accounting and tax, or A&T. The report suggests complexity here is only expected to increase. No relief in sight.
That's the clear expectation coming from the survey respondents, unfortunately. 40% of jurisdictions anticipate increased A&T complexity in the coming years.
And digitization, you know, you might hope technology would simplify accounting and tax, make it easier, but it seems to be a bit of a double-edged sword.
It absolutely is. From the perspective of tax authorities, digitization is great. It increases their efficiency, they get data faster, more directly, often automatically.
Right.
But for businesses, it often adds complexity. It demands far more granular data than before. It often requires reporting in real-time or near real-time rhythms. And it forces companies to adapt their internal systems to connect with local digital platforms and comply with very specific, often rigid data formats.
That sounds expensive and difficult.
It can be. As one A&T expert is quoted in the source, not all companies have systems sophisticated enough to handle this level of digital reporting easily, especially smaller businesses. It requires significant investment.
What are some of the specific regulatory drivers making A&T more complex, besides digitization?
While you see region-specific rules that differ significantly, Latin America is particularly highlighted for having complex and varied A&T environments. Overlapping taxes are a big issue in some places where multiple levels of government, maybe federal, state, and municipal, all levy different taxes on the same activity. Brazil is the classic example.
Right, the infamous Brazil cost.
Exactly. And frequent changes to tax laws are a major burden, too. Colombia is cited as a place where tax regulations change often, making compliance difficult. Even a lack of transparency in the regulations themselves can increase complexity. El Salvador is mentioned for requiring all entities to appoint a dedicated compliance officer just to navigate the rules effectively.
And is relying on local accounting standards still common? I thought everything was moving towards global standards like IFRS.
It's moving, but slowly in some areas. 60% of jurisdictions still significantly rely on their own local, generally accepted accounting principles, local GAAP.
60% is a lot.
It is. It means companies operating internationally can't just use one set of rules, like IFRS or US GAAP, everywhere. They have to navigate distinct country-specific rules, which often requires complex reconciliations. Hungary is cited for having particularly strict and even tightening local GAAP rules. So while there's a global movement towards standards like IFRS, local GAAP remains dominant in many places, adding that layer of conversion and compliance complexity.
And that push for digital tax filing, we talked about e-invoicing, direct data uploads, that increases scrutiny and reduces the room for error, presumably.
Absolutely. The trend towards digital tax filing requirements is definitely accelerating. E-invoicing is now mandated for at least some types of businesses in 54% of jurisdictions surveyed, and direct uploads of financial data to government platforms are required in 49%.
So nearly half require direct data uploads.
Yeah. And while the stated aim is usually efficiency and reducing tax evasion, the practical effect for businesses is that they have to get it right the first time. The margin for error is significantly reduced when the data goes straight to the tax authority's system.
And the consequences for not getting it right for non-compliance are getting more severe.
Significantly more severe in some cases, according to the report. It highlights increased penalties for things like late filing. 23% of jurisdictions reported the possibility of authorities actually banning a company's operations for late filing. And a notable 16% mentioned potential imprisonment as a consequence.
Wow. Imprisonment for late tax filing.
It sounds extreme, but it's reported as a possibility in some jurisdictions. For inaccurate calculations, the potential consequences are also serious. 29% report possible license suspension, and 32% again mention the possibility of imprisonment. Now, most jurisdictions, 73%, do allow corrections, but they usually come with hefty fines.
So the stakes are high.
It's very high. This environment really demands proactive management. As a China expert quote emphasizes, businesses need to move from just passive compliance to actively monitoring and managing their tax risk posture.
Is there also a talent shortage in accounting itself, making it harder to manage all this?
Yes, the report points to a clear skills gap in the accounting profession globally. This is partly attributed to the increasing complexity of the field, needing tech skills alongside traditional accounting, and perhaps, as one expert suggests, a lack of interest or passion from younger generations in pursuing accounting careers.
Huh?
And this shortage is made worse by the growing requirement for a certified public accountant, a CPA or equivalent, to sign off on financial statements. That's now required in 48% of jurisdictions, and enforcement of this rule seems to be increasing.
So more complex rules, fewer skilled people available to handle them.
Yeah.
How are companies coping?
Outsourcing is becoming a very common strategy. Companies increasingly outsource their accounting functions, or parts of them, to specialized firms. These firms have the necessary expertise to navigate the complex digital and regulatory landscape, especially when companies don't have the internal resources or just struggle to hire qualified accountants.
Makes sense. And how do big global initiatives like the OECD's BEPS project and Pillar 2 fit into this complexity picture? Are they helping or hindering?
They're definitely adding another significant layer of complexity, particularly for multinational enterprises, MNEs. The BEPS initiative, base erosion and profit shifting, aims to prevent tax avoiding strategies used by some multinationals. 82% of jurisdictions surveyed have now implemented some BEPS-related regulations.
That's a lot.
It is, and about a third of jurisdictions now mandate specific electronic transaction reporting standards like SAFT, that's the standard audit file for tax. These are all designed to increase transparency and fairness globally, but they add considerable compliance burden and costs for businesses.
In Pillar 2, the global minimum tax.
That sounds complicated.
It is incredibly complicated. Pillar 2 requires large MNEs, those above a certain revenue threshold, to ensure they pay a minimum corporate tax rate of 15% on their profits globally, regardless of where those profits are officially booked.
And they even calculate that.
It forces these MNEs to undertake extremely complex calculations, collect incredibly granular data from all their subsidiaries worldwide, and then file detailed reports demonstrating compliance in every jurisdiction they operate in. It's a massive undertaking. It adds a significant new layer of global complexity. A Bulgaria expert is quoted noting how these OECD measures, like Pillar 2, are increasing reporting requirements and tax complexity right across the EU.
All right, so boiling it down again, what's the core takeaway for accounting and tax complexity?
The clear, undeniable trend is that tax authorities worldwide are rapidly leveraging technology. They want real-time granular insight into business transactions. This is highly efficient for them, but it dramatically increases the compliance burden and the risk for businesses. The talent shortage makes finding the necessary internal expertise harder, pushing more firms towards external providers just to keep up with the pace of change, the potential severity of penalties. And what's really fascinating, I think, is how these global standards like BEPS and Pillar 2, which are intended to create fairness and consistency, are actually being adopted and interpreted unevenly across different jurisdictions.
So creating new complexities.
Exactly. They're creating layered and sometimes even conflicting requirements that add their own unique brand of complexity to the mix. It's not simple harmonization yet.
So the bottom line for you, our listener, if your work involves any kind of financial reporting, tax compliance, anything like that, this tells you the future is definitely digital, the rules are getting stricter, and the demand for specialized knowledge, whether you build it internally or buy it externally, is only going to grow.
It's really an area where ignoring the changes or trying to muddle through could have very significant financial and operational consequences down the line.
Okay, let's move to our second core business area from the report, Global Entity Management, or GGM. This is all about the nitty-gritty of setting up and managing legal entities, companies, subsidiaries in different countries. The report notes that while over half the jurisdictions expect complexity here to stay stable, it's already pretty complex to begin with, right? Especially for businesses operating internationally.
Oh, absolutely. It's inherently complex just to navigate the different legal and administrative requirements of various national systems simply to exist legally as a registered entity. It's the basic blocking and tackling of being a global company.
And geopolitical instability and frequent policy changes must add another layer of difficulty here, too.
A significant layer of unpredictability, yes. The report actually notes a slight decrease in the perceived midterm political and geopolitical stability outlook compared to last year, citing upcoming changes or uncertainties in regions like the EU and the US as contributing factors.
So more uncertainty ahead. Any specific examples from the report where instability is adding GM complexity?
Yes, it cites markets like Brazil, Indonesia, and Saudi Arabia as experiencing increased complexity due to changing regulations, sometimes unpredictable bureaucracy, and just heightened risk factors associated with instability. And places like Venezuela, Ecuador, and Kazakhstan are noted for still relying heavily on manual, paper-based processes for entity management. That inherently adds time, cost, and administrative hurdles compared to more digitized systems. You physically have to move paper around.
Right, and simplification in GIM. Is that happening anywhere? Are things getting easier?
Extremely rare, according to the report. Only 9% of jurisdictions actually expect the rules around entity management to get simpler in the coming years.
Only 9%.
Yeah. The general pace of regulatory change in this area seems to be accelerating rather than slowing down. So more change, usually meaning more complexity.
How does technology factor into GIM complexity? Seems like it could help streamline things, but maybe it adds complexity in other ways.
It's definitely a mixed picture, much like we saw in accounting and tax. Where technology is implemented effectively by governments, it does help. Digital platforms for entity registration, filing updates, handling compliance tasks like those mentioned in Austria, Singapore, and Egypt, has the Javify online portal as a good example. They can significantly speed up processes and reduce bureaucratic steps.
Okay, so tech can be good.
It can be. However, where technology adoption is lacking, either by the government or by the businesses themselves, complexity remains high because you're still reliant on those manual, often paper-based processes. The report specifically notes South America as generally lagging in leveraging technology to reduce GM complexity. And it links back to the Ecuador example again, where uneven physical infrastructure actually contributes to bottlenecks in administrative processes too, not just supply chains.
So the benefits of technology in making entity management easier are pretty unevenly distributed around the world.
Precisely, and localization challenges remain a huge ongoing factor driving GM complexity everywhere.
What kind of localization challenges are we talking about here?
Well, think about basic language requirements. The report mentions potential future requirements for using the Kazakh language in business dealings in China as an example of how language can be a hurdle. You're often dealing with multiple different regulatory bodies within a single country, not just one ministry.
Ah, okay.
There are always jurisdiction-specific norms and sometimes unwritten rules you just have to learn and understand to get things done. Spain's 17 autonomous regional governments are cited as a prime example of how navigating local nuances within a single country can add significant complexity. And then there are just the general bureaucratic hurdles in getting essential permits and licenses approved. It can be slow and opaque.
And expected legislative changes add another layer of uncertainty and complexity, even in this foundational area of just setting up a company.
Yes, a notable 23% of jurisdictions anticipate major legislative changes impacting global entity management in the next 5 years. So nearly a quarter expect significant rule changes.
And that figure is higher in some regions.
Higher in EMEA, yes, 29% there expect major changes. And these changes can definitely add complexity and potentially slow down operations. The report mentions stricter anti-money laundering, AML, and Know Your Customer (KYC) processes in Croatia, for example, which are apparently delaying the opening of bank accounts for new entities. Slows everything down.
Right. More checks, more time.
Exactly. And the global push for greater transparency is also increasing scrutiny, particularly on foreign-owned entities. Things like beneficial ownership registers, which require companies to publicly disclose who their ultimate individual owners are being implemented or strengthened in places like Brazil, China, and Costa Rica. More data to provide, more compliance.
So more rules, more scrutiny, more complexity seems to be the overarching trend here too.
That's generally the trend, yes. The report explicitly links that higher expectation of legislative change, seen particularly in EMEA, to a higher expectation of overall regulatory complexity in that region. 51% in EMEA expect GEM complexity to increase compared to 43% in APAC.
But can legislative changes ever help? Can they simplify things?
Occasionally, yes. The report does acknowledge that some legislative changes can be designed specifically to help attract foreign investment by simplifying processes. It cites Italy's recent capital law as an example, which aims to make fundraising easier for companies there. So it's not always about adding burden, but the overall trend seems to be towards more complexity.
Okay, so pulling this all together for global entity management, what's the big picture?
Well, if we connect this to everything else, setting up and managing your legal entities across different countries is clearly far from a simple administrative checklist you tick off once.
Yeah.
It's about constantly navigating this evolving legal and political landscape. Technology is playing a role, yes, but its effectiveness is unevenly applied across the globe. And that global drive for greater transparency is definitely increasing the level of scrutiny, especially on foreign entities. It demands more robust, more adaptable internal processes and just significant attention to detail from businesses managing international operations.
So for you, our listener, if you're involved in international expansion, maybe M&A activity, or simply managing existing foreign subsidiaries,
Yeah.
this really highlights the ongoing dynamic nature of the administrative and compliance hurdles. You need to anticipate them, budget for them, manage them. It's not a one-time setup cost.
No, it's continuous management of a constantly shifting environment. It really requires vigilance and adaptability.
Okay, now let's quickly look at the complexity rankings the report provides. It gives us these lists, doesn't it, of the most and least complex jurisdictions based on all the analysis we've been talking about.
Exactly. It's a way to sort of summarize the overall administrative burden across these different areas, A&T, GEM, HR, and payroll. According to this 2025 index, the top 10 most complex jurisdictions for businesses are, starting with the most complex, Greece, then France, Mexico, Turkey, Colombia, Brazil, Italy, Bolivia, Kazakhstan, and China, rounding out the top 10.
Greece is number one again. They seem to consistently top this list. Let's pick a couple from that top 10 and highlight a specific reason the report gives for their complexity, linking it back to our discussion. Why Greece?
Yeah, Greece's top ranking, according to the report, is largely attributed to constant legislative changes. These changes are particularly impactful in accounting and tax, and also in HR and payroll rules. They specifically mentioned the cost and the complexity added by things like the MyDaya electronic bookkeeping system and the introduction of digital payroll cards. These require significant ongoing investment in technology and compliance expertise just to keep up.
Okay, and France is high on the list too, number two. Why is France so complex?
France is cited for its famously intricate administrative and regulatory environment. Specific factors mentioned include multi-layered payroll regulations, which often require specialized CPA support to navigate correctly very strict labor laws, and mandatory adherence to French accounting norms, local GAAP. Plus, the fact that most administrative processes must be conducted in French adds another practical layer of complexity for non-French speaking businesses.
Right. And Brazil, which we've mentioned several times, comes in at number 6, still very high.
Brazil's complexity, according to the report description, is heavily driven by its accounting and tax environment, as we discussed. The difficulty of integrating its unique, complex tax systems with global accounting standards like IFRS or US GAAP is a major factor, and that's compounded by ongoing, complex tax reform discussions that create uncertainty, plus the sheer volume of overlapping taxes levied at the federal, state, and municipal levels. It's just layers upon layers.
Okay, so that gives a flavor of why those places are considered the most complex administratively. What about the other end of the scale? The least complex places, the bottom 10.
Right. The report ranks all 79 jurisdictions. The bottom 10, starting from number 70 and getting simpler, are the Czech Republic, then Curacao, the British Virgin Islands, BVI, Jamaica, the Netherlands, Jersey, Hong Kong, New Zealand, Denmark, and finally the Cayman Islands at number 79, ranked as the least complex jurisdiction in the index this year.
Denmark is consistently low in complexity, number 78 this year. Why is it generally so simple to do business there, according to the report?
The report credits Denmark's consistently stable legal and regulatory environment. That stability reduces uncertainty and the need for constant adaptation by businesses. It also has a very high level of digitization in government services, which simplifies business setup, reporting, and interactions significantly. And they also note significant government investment in AI and technology initiatives specifically designed to support business operations and reduce administrative burden further.
Okay. Hong Kong is also near the bottom, number 76. What makes it simple?
Hong Kong is highlighted primarily for its simple, low-tax system and its relatively straightforward business setup and employment laws. The report specifically mentions its payroll operations as being particularly easy to manage compared to complex neighbors like Japan, mainland China, or even Australia, partly because it has minimal Social Security contribution requirements compared to many other places.
And the Cayman Islands, ranking is the very least complex at number 79. Why is that?
The report points to the Cayman Islands' mature and stable financial system, its stable political environment, and again, a high level of digitization as key factors contributing to its low complexity score. These factors apparently make it particularly efficient for remote operations, which suits its key sectors of financial services and tourism very well.
What stands out to you looking at that list of the least complex places? Does it mean it's just smooth sailing if you operate there? No problems at all.
Not at all, actually. What's interesting is that even in these quote-unquote least complex places, the report still mentions specific challenges. For instance, they note potential difficulties in opening bank accounts in both the Czech Republic and Denmark, despite their overall simplicity. Curacao and the Netherlands, while simple overall, are noted for having stricter HR regulations compared to other aspects of their business environment.
Ah, so complexity within simplicity.
Exactly. The British Virgin Islands, while low complexity overall, experiences frequent legislative changes, which can add some unpredictability. And Jersey, another financial center, faces increased regulatory scrutiny due to international pressures on offshore jurisdictions. So the key takeaway is low complexity doesn't mean no complexity. It just means the overall administrative burden, averaged across different functions, is comparatively lower than elsewhere. There are still specific hurdles to navigate.
And for you, our listener, the message here is that while these lists provide a useful snapshot, the real value isn't just knowing the ranking number. It's understanding why places are ranked where they are.
Mm-hmm.
It's understanding, based on these underlying factors, we've spent this whole deep dive discussing the nature of the regulations, the level of digitization, the talent landscape, political stability, and so on. That deeper understanding is what truly helps inform strategic decisions about where to operate, where to invest, or where to expand, based on the specific types of challenges your business is willing and able to take on.
It really provides the essential context behind those numbers on the list.
So as we wrap up this deep dive into the 2025 Global Business Complexity Index report, wow, we've covered a lot of ground. We've looked at this really complex interplay of forces shaping the global business environment right now.
We really have.
The impact of geopolitical uncertainty, those vulnerabilities in global supply chains, the dramatically evolving labor markets with shifting expectations, and those persistent, often increasing regulatory changes impacting core business functions like accounting and tax and global entity management.
Yeah, all those pieces interacting.
And we circle back several times to that key point from the very beginning. The report really underscores that uncertainty, those sudden, unpredictable shifts, is arguably the primary challenge businesses face today.
Right.
Maybe even more so than the predictable day-to-day administrative complexity, however burdensome that might be.
And navigating this turbulent landscape, the report concludes, really demands agility. It demands a commitment to staying constantly informed about changing conditions, which is hard work in itself. And it requires maintaining a clear forward vision even when the fog of uncertainty is thick.
Yeah.
It also highlights the crucial role of professional insight, getting good advice, and using established networks to successfully maneuver through unfamiliar regulatory environments and adapt quickly to dynamic market conditions. You can't do it all alone.
Looking ahead, then, there's that fascinating tension we touched on that this report really brings into sharp focus for me. On one hand, you have technology as this powerful force driving efficiency, promising simplification through digitization. We see that potential. Yet, as we saw particularly in A&T and even GM, this very same digitization often adds new layers of complexity in practice. It demands more data, stricter reporting formats, significant investment in adapting systems. It's not an easy win.
That's right. And simultaneously, you have these external pressures from geopolitical forces, from the need for supply chain resilience, pushing businesses towards greater diversification, diversifying trade corridors, diversifying suppliers, diversifying markets, spreading out.
But internally, as we discussed, companies are actively seeking the opposite in many areas: uniformity and simplification. Consolidating vendors, standardizing processes, particularly in those core back-office functions like HR and payroll, pulling things in.
And that's the fundamental strategic paradox playing out globally right now, isn't it? External fragmentation, driven by risk mitigation, meeting internal consolidation, driven by the need for operational efficiency and control, diversification versus simplification.
How will this inherent tension, this simultaneous pull towards external diversification and internal simplification, how will that ultimately play out and reshape the global business landscape over the next few years?
That's the really provocative question, I think, that this report leaves us with. It's definitely something worth deeply considering as you navigate your own corner of this increasingly complex and undeniably uncertain global business world.
Indeed. A huge amount to think about there. That's all the time we have for this deep dive. We sincerely hope this analysis of the GBCI 2025 report has provided you with some valuable insights, maybe some useful context, and helped you feel just a bit more informed about the challenges and maybe the opportunities that lie ahead.